Good afternoon. I'm Dave Muth with People's Company Capital Markets, and I'm happy to be joined today by Dave Brown, founder of IPE 1031. We wanted to talk to folks a little bit about Section 1031 exchanges, and then also the Delaware Statutory Trust vehicle as a mechanism to facilitate those exchanges. So, Dave, thanks for joining, and maybe a little bit of background on yourself and IPE 1031.
You bet, Dave. Well, thank you very much for the opportunity to connect with you and in your audience. Again, Dave Brown. I'm the president of IPE 1031. We are a qualified intermediary company based in Des Moines, Iowa. We have a really strong focus on ag land exchanges by virtue of being, in the heart of Iowa in the Midwest. And as far as our company, we started IPE 1031 in 2003. We've grown into one of the largest exchange companies in our national trade organization, having handled thousands of exchanges over the years, totaling billions of dollars of value. So we've seen everything there is to see with 1031 exchanges. We work on a national basis. My background, I'm an attorney by trade, basically counsel for the exchange company, but in addition, hold the designation of certified exchange specialist. And again, appreciate, Dave, the chance to visit with you.
Yeah, excellent. And, we see a lot of 1031 exchanges in our farmland transactional business. And, it feels complicated, and there are some really specific guidelines and guardrails and rules that need to be followed. So I think first thing we want to do, Dave, is just start out and let you give us a little bit of basic background on the 1031 exchange.
Absolutely. Well, so Section 1031 has been in the Internal Revenue Code for 100 years, more than 100 years. It was first enacted in 1921. Congress recognized that they wanted to incentivize landowners, property owners to reinvest dollars into new assets to keep money flowing through the economy. So, a common example of what we would see is somebody who is selling a retail building or a single family rental or maybe a duplex or any investment real property, and they decide to exchange into another replacement property asset. And ordinarily, if somebody cashed out of that asset, they would have to pay tax on the sale. But Section 1031 allows somebody to defer the tax on that gain, provided they purchase replacement property within certain guidelines and parameters. So 1031 really is just that continuity investment. It incentivizes real property owners to continue to keep their dollars flowing in the economy. And that's why it has stood the test of time for 100 years and been one of the greatest tools for property owners to continue to grow their investments. Let me go back here a little bit, Dave. Some other, here are some advantages. Under 1031, any real property can be exchanged for any other real property. So we'll go through some of the slides, but if somebody is involved with, as I mentioned, a single family rental and they want to go into a farm or they have commercial assets, you can go into different asset types. You can drive greater potential cash flow. One example in that case, say somebody owns a bare commercial lot that is not producing income, maybe a drag due to commercial property taxes, and say they would want to go into a cash rent asset, such as a farmland that you're offering through DST farmland. Any real property in the U.S. can be exchanged for any other real property in the U.S. That's the relocation point. And in Section 1031, one of the real powerful tools, for those especially who are older, is 1031 allows folks to retain their asset, and upon death, the heirs receive what's referred to as a stepped up basis. And what that means is if using an example, if a couple purchased an apartment complex worth $200,000 a few years ago, and they're selling it for $500,000, and it appreciates they hold it until death and maybe they pass and it's worth, $700,000, the heirs would receive a basis step up to the $700,000. And if they cash out, they wouldn't have to pay the tax. So, exchanging through the life of an investment can benefit for estate planning purposes. And then the next slide, Dave, demonstrates the appreciation and leverage and how 1031 is really an incredibly powerful tool. And I'll have you speak a little bit to this, after I sort of set the table. But my understanding is that over many decades, the return of farmland has exceeded 10% when factoring in income and appreciation. So if 1031 is a time value compounding tool, and this chart demonstrates that if somebody were to retain this 160-acre parcel for $1.5 million that they sell, $500,000 basis. A basis is really the initial investment that folks make, and that initial investment is not taxed. That's their money. So on $1 million gain, if that 160-acre parcel was sold, and they continue to keep those dollars rolling through a 1031 exchange, this slide shows the intervals and how much additional growth to the portfolio would be derived over this defined period.
Yeah, and we were just working on this data here over the past few weeks. If we look at Iowa as an example, right, from 1991 through 2022, the average annual total return is 11.6% over that period. So that even exceeds this illustration of 10%. And so this compounding effect of being able to protect that cap gains. And then to your point on the previous slide, Dave, on being able to grab the stepped up basis and create a transfer of that capital gains saving from a legacy standpoint, this is really significantly impactful.
Absolutely. I'm going to go through some important rules, and much of this can be found on our website, which is www.ipe1031.com. We have some reference guides at the bottom of the first page, as well as a red flag. They're PDFs that can be downloaded. A couple of really handy references to the extent folks want to follow up after. But really a quick hitter important one. So in order to do a 1031 exchange, let's just assume that we have this single family rental that's being sold for $300,000, and let's assume that the basis is $100,000. That's the original investment. There might have been some depreciation, and they have $200,000 of gain that they would like to sell that $300,000 asset and maybe go into a replacement property. What's really critically important is that prior to the closing of the sale of that asset, so let's just assume, today is October 25th, and let's just say closing is going to occur November 15. A qualified intermediary must put documents in place and be designated prior to that closing. And that's what our company specializes in. We manage the exchange process, make sure that the IRS rules have been complied with, and walk the exchanger through that process. But you absolutely need to have you need to be working with a qualified intermediary prior to the closing. Now, using my November 15 example, on that closing date, the exchanger has 45 days to identify new property. And identification is a form that we, provide to the exchanger in the process and walk them through. But, essentially, within that 45-day period, you have to pick out new properties that you're going to acquire if you want to move forward. You can elect on day 45 to not identify, and you would get the money back on day 46. But let's just say that you get to day 44 and, you're looking for options. You have a couple, and maybe, you're working with Dave on a DST replacement property. That identification form needs to be made within the 45 days. And then after day 45, that cannot be changed for what it's worth. You're stuck with whatever you identify. So it's really important to make sure you've done your legwork during that period. The other important rule is that, again, from that, in my example, the November 15 closing date, there would be 180 days from that period to wrap up the entire transaction. and that, essentially translates to acquiring one of the replacement properties that were identified.
Yeah, and Dave, really quick, we see it across the board in terms of these rules. There we'll have folks that we work with that will hold off on even putting a property up for sale until they have a pretty good idea where that exchange is going to go. You also see scenarios where folks will have a transactional opportunity that's really beneficial to them and then fall into the 45-day window. And you can certainly see where that time period can go pretty quickly, depending on exactly what they're looking for. So really encourage folks to get engaged with the QI, the qualified intermediary, early and understand where they have to sit.
Absolutely. Now, I'll go through this slide quickly, but your qualified intermediary it has to be a disinterested third party under the IRS rules. It can't be your attorney, accountant, real estate broker, investment advisor. It can't be an employer. You can't have family members handle that. I mentioned that I'm an attorney, but we don't have a law practice. We don't represent folks in legally. So our company, because we focus exclusively on helping with 1031 exchanges, we are qualified to handle exchanges for any exchanger who wants to work with us. But beyond that, working with a qualified intermediary that's experienced and understand exchanges is really key. I think some value add that we can provide to the process, at the start, even when just planning for a 1031 exchange, the sooner you can connect with us, the better. We can walk you through, ask the right questions, figure out where you're at, help, put you in the right position so that it's efficient, smooth, and handled the right way. But we're happy to serve as a resource for any of you who are looking to do 1031 exchanges and fulfill that key function that you would need to have if you move forward. All right, so one of the, I guess, the bigger, questions and things that, we need to be concerned with in a 1031 exchange is that identification period that I mentioned. There are 3 rules. I'm going to go through the 2 most common. And when I say the most common, this is what we see 99.9% of the time. So, let's say in my prior example, you're selling that $300,000 single family rental. During that 45-day period, you can choose from the 3 property rule or the 200% rule. And the 3 property rule means that you can identify any 3 properties, put them on the form, and you can choose, to acquire 1, 2, 3 of those or none of them. But you're limited to 3 properties with the identification. The other is the 200% rule, which in many cases is commonly what we see with Delaware Statutory Trust replacement properties. But, let's just say that, so you're selling for $300,000 and somebody wants to acquire 4, additional single family rentals, or identify at least. Well, there's more than 3, so they can't use the 3 property rule. So under that 200% rule, if there were 4 different assets that they wanted to purchase, they could do that provided the total of the 4 didn't exceed, $600,000. So you sell for $300,000, you buy, you can identify up to $600,000. More commonly, the 200% rule is sort of some higher value transactions. So if somebody sold $100,000 farm or $1 million farm, and they're going to, identify 4 different farms worth, $500,000 each, they could identify, 4 properties provided the total value did not exceed $2 million. So that, again, sell for $1 million, double that for $2 million. That's the cap that you have to identify. Now, identification is, I mentioned, a key consideration with Delaware Statutory Trust. In many cases, you will be identifying a percentage interest in that DST interest. So, assume the offering is, a $6 million offering and somebody has $500,000 to invest into that offering, the percentage of $6 million is what would be identified. So, it's important in the context of identifying DSTs to make sure that that's done correctly. Let's talk a little bit about what types of properties qualify for a 1031 exchange. Now, broadly speaking, any investment property or any property held for use in a trade or business qualifies. Now, personal property cannot be exchanged. In 2017, in the Tax Cuts and Jobs Act, personal property exchanges were replaced with immediate expensing. So 1031 applies to real estate only. Any of the properties, asset types that you're seeing on the screen can be exchanged for any other asset type. So I mentioned a retail building or an apartment complex or a convenience store, office building. Those could all go into each other, or they could go into a farm or vacation homes in some very limited circumstances with limited personal use. But the point here is that any real estate that's held for investment can be exchanged for any other investment real estate. This was talked about the next slide, Dave. We get into the partial interest discussion. But most folks think of when we're selling a real estate, we're selling the full property for another full interest in a property. So a house for a farm or a commercial asset for mini storage units, 100% of one interest for 100% of the other. That doesn't necessarily need to be the case. And a lot of times, and Dave, you can sure speak to this in your farmland practice, but you'll have siblings that own 5 siblings that each own an undivided 1/5 interest in 160 acres. And so the question is as tenants in common, each of them owns 1/5 of that 160. Can they go their own separate ways and exchange their 20% interest into something that they own just themselves? And the answer is absolutely they can. And besides that, they can also exchange into a partial interest in another replacement property. Again, in the DST context, if somebody wants to buy a portion of that DST or a percentage of that, they can under the guidelines that the IRS put out relating to where they blessed replacement properties that are offered as Delaware Statutory Trust. But this gets into some of the other types of assets, other notable ones. Permanent conservation easements. Sometimes farmers will or landowners will sell a permanent easement to the NRCS for wetlands or for flooding. There's some flooding easements. There are some historical easements where you have historical societies that will buy land to keep it from being developed, and they pay you the value of that asset so that it remains in conservation. And a lot of that's used for the nutrient reduction strategies, improving groundwater in the Gulf of Mexico. You see that all over as well as the coast. You see that all over the country. Other notes, any pipeline sales, sometimes there's some portions of that can be exchanged, but they can be a little challenging in a 1031 context. So it's really important to dive into the details of those. But even though you may not necessarily be able to do an exchange, that doesn't mean that they can't, those dollars can't be reinvested into some other asset under different circumstances.
Yeah, and Dave, throwing in just a little bit on the farmland and the agricultural property dynamic, you see a lot of multi-generational legacy assets. Stepping back to that point you made earlier about stepped up basis and the advantages that you get there, you run into these partial interest scenarios quite a bit. And I think what's important is thinking about that in the context of the transition to the heirs and making sure that things are structured correctly. And then also making sure that you have the right acquisition structures in scenarios where you are looking to exchange into a different partial interest. So those are a couple of flags that we certainly see that a resource like your company can be a great tool for folks to be able to help make sure they're heading in the right direction.
All right, and there's this slide is actually there's a lot to it, more than would maybe appear. I would again invite you to go to our website, www.ipe1031.com. At the bottom, there's a top 10 exchange red flags, which is this is drawn from. And I'm gonna zoom through these, but again, first and foremost, if you're looking to undertake the 1031 exchange, make sure that you have the exchange qualified intermediary in place before you close. Planning. So if somebody can reach out to us, or you can reach out to your tax and legal advisors at the beginning to make sure the right questions are asked, you can avoid a lot of problems and a lot of potential hiccups in the future. A critical component of any exchange is the purchase agreement needs to be assignable to a qualified intermediary. And without getting into all the nuts and bolts of that, there should be some 1031 cooperation language in your purchase agreements as you're negotiating sales that you'll want to have in there. And again, there's an example paragraph on our website for that. I'm going to talk in depth about trading down in value in a couple more slides because that's pretty critical, especially with DST replacement properties. So I'm going to skip over that. Reverse exchanges. A lot of times, a reverse exchange, let's just say somebody wants to purchase a replacement property and has to close on that asset before they're able to sell and close on their property they're giving up or their relinquished property. The reverse exchange is a mechanism that allows that replacement property to be parked with us for up to 180 days, and then allows them that 180-day period to sell their relinquished property and trade back into it. It's an incredible tool and something to consider if you're running into timing issues. I talked about documenting the exchange, that's where we come in. Related party transactions. Anytime somebody is acquiring property from a related party, that can be a prohibited transaction. There are exceptions, but anytime you have family 1031 transactions or family members involved, that's where you definitely need to connect with somebody who like us who can help you with that. Flippers and dealers. So quickly, if folks are buying houses with the intent to fix them up and resell immediately for a profit, those properties do not qualify for 1031 treatment. There are some other scenarios where those don't work as well. When properties are held primarily for resale, again, pretty fact specific and needs to be addressed with the advisors up front. Settlement statement issues. Working in the context of a DST, there's lots of expenses and costs that could create potential hiccups or a taxable event. I know that's a real focus, that Dave and his group put on, is making sure that things are handled the right way. But reviewing settlement statements carefully and avoiding unexpected surprises is important. The last thing I would mention is partnership issues most commonly are confronted when you have an LLC, multi-members in the LLC. So say we have 3 business partners or 3 friends who have Joe, Tom, and Jane LLC. Joe, Tom, and Jane cannot exchange separately and go into separate replacement properties because partnership, that's considered a partnership interest and not a real property interest. I know that's probably a little overcomplicated for the discussion, other than to point out that whenever folks own property in a business entity together, that can create hiccups for exchange purposes that we have to look into. And again, that's the super high highlights on it, and we can visit about that if anybody has questions, or you can refer to our website.
And really, it's the right place to make sure they're engaged with the professionals that can help walk through, because it's those are the elements that you want to make sure that you don't create a taxable event in the process.
Absolutely. Okay, so I think I have 3 or 4 slides devoted to how do we defer all the tax. This is one of the most commonly misunderstood things that we see in 1031 exchanges. So let's use my $300,000 example. Before you have the rental house that's being sold, we have a $100,000 basis, which means we have $200,000 of gain. A lot of folks think that all you have to do is reinvest that $200,000 of gain and then have the tax be fully deferred. That's not correct. To defer all your tax, you need to buy as much or more than what you sell for. And if you do, then you can defer all that tax. But, in my example, if you sell for $300,000, you need to buy for $300,000 or more to defer all the tax. And there's a couple other corollaries besides that, is that, whatever equity is received from the transaction needs to be fully reinvested. And then also you need to replace the debt, have as much or more debt on that replacement property to defer all the tax. Dave, go to the next slide. I think that demonstrates it a little more clearly. In this example, we're selling for $1 million. We had $500,000 of debt that we paid off at the closing, and leaving exchange equity of $500,000 that goes into an account at closing that we set up and hold on the exchanger's behalf. So as long as that replacement property value matches up, we've deferred all the tax. And you can see these examples. This works great. You can do a partially deferred exchange, and that's fine. Let's look at the next slide. In this case, let's just say that the basis was $500,000. That matches up with our equity amount. So if our basis is $500,000 and we sell for $1 million, that means we have $500,000 of gain. In this case, they only purchased $800,000 worth of property, which means they traded down by $200,000. Anytime there's a trade down in value, there's going to be a taxable event. So in this case, we didn't reinvest $200,000 of debt. The exchanger's not in the same position on the new property as they were on the old property. And because they've either pulled out cash or they've reduced their debt obligations, the government says, hey, you have $200,000, whether it be in the form of debt relief or cash, to pay us a portion of the tax. In my example of a $500,000 basis, by purchasing $800,000 of property, we've deferred $300,000 of gain. That being the difference between the $500,000 basis and $800,000 we purchased. And again, we pay tax on the $200,000. So, you can do a partially deferred exchange, and in many cases, it makes sense to pull some cash out and use it for other purposes. So I don't want folks to come away with the thought that, gosh, I have to buy as much or more than what I sold for to do an exchange at all. You can do a partial transaction. And then the last point here is anytime folks pull cash out, cash is always going to be taxed. So the government assumes that if you have $100,000 in your pocket in this example, because we didn't reinvest the full $500,000 of equity, that $100,000 of cash is going to result in a taxable situation, even though they purchased more than what they sold for in this example. Now, relating to Delaware Statutory Trust investments, one of the benefits, which Dave will talk about here in a bit, is that you can match up the equity in most cases with the equity that's being offered as far as the offering equity that's going into the DST. So it takes some planning with your tax person and making sure things are identified the right way, and you're matching up the equity and the debt on the replacement side. But it's a pretty unique and good tool to be able to make sure you do fully reinvest all those dollars.
Yes, thank you, Dave. That is actually one of the key interesting dynamics and value adds of the Delaware Statutory Trust, we'll refer to as DSTs going forward, is that ability to work into a pre-configured structure so that you understand those equity and debt dynamics and are able to sort of scale that exchange to work correctly for your needs. Just a really quick snapshot, right? So the DST marketplace is pretty robust, right? We step back to 2021, about 7.4 billion in DST transactions. We've heard this is up over 10 billion a year now. Certainly with the highly appreciated real estate across all sectors and asset classes, that makes quite a bit of sense. Typically, you're going to get your return through cash yield, right? That 5 to 10%, a good chunk of that is going to be cash yield focused. And it comes through these sort of commercial, residential, industrial, and office storage units, kinds of DSTs. There's a lot of companies and a lot of active offerings that are out there. This marketplace is pretty robust. A little bit more about what the DST is, right? So it's a single purpose entity. This trust will provide the opportunity to exchange into beneficial interest of the trust. Okay, this was created under Delaware law. The securities rules and laws are really clear. They're very highly regulated structures, and it fits into this real estate ownership that Dave kind of talked about earlier, direct passive ownership. And you can have one asset or multiple assets. Certainly a lot of the commercial DSTs may be a collection of assets that think about something like a Walgreens or a chain sort of retailer like that, that could be pulled together into a DST offering. And then that direct ownership gives all of those benefits on an annual basis to the beneficial owners of the trust. And one key point is a DST is eligible for exchange both into and then also out of the structure. So moving pretty quickly here, let's talk a little bit about how the exchanges and the process that Dave just walked us through kind of fit together with the DST. So Dave talked about that 45-day identification period. One of the things that's really important and pretty useful for DSTs is these offerings are already configured. When they make it out to the marketplace for folks to identify, the deal is put together, all of the terms and the structures of that offering, understanding what the debt ratios are in order to make sure that you're lining that debt and equity up. This creates and reduces quite a bit of the hassle associated with the identification process, because you can work through and understand pretty quickly and in detail how the DST can work for your exchange. One of the really useful outcomes is this notion of excess boot. So if you use some of the examples that Dave talked about, where you're selling an asset, a property, and you're trying to exchange into another individual property, perhaps there's a specific opportunity that emerged that led you to make that transaction, but you may have some excess money, some leftover money, to the example that he put earlier around buying down. You can still preserve or restrict that capital gains by looking at a DST to fill that sort of excess boot from the transaction. Another thing that we see in the marketplace is a DST on that sort of identification list that Dave talked about as a backup, right? Because we know that these DSTs are out there configured, ready to go. And if something happened with closing on another asset that was maybe a priority, you'd still have that DST there as an opportunity to preserve that cap gains loss. One thing, this is sort of some of the advantages. Dave, you certainly have seen plenty of exchanges into DSTs. Are there some red flags or some things to watch out for on the DST front?
Yeah, I mean, really, I think that the sponsor making sure that the exchange process is treated with importance, and that the offering itself is also managed correctly, and the management of the asset itself has to fall within certain guidelines and parameters under the DST rules. But working with a company that really has a strong investment, and does the diligence to make sure that the asset is structured, the right way is critical. And in addition, the closing process, I mean, the identification process, we see varying degrees of attention to and expertise, in making sure that that's done the right way. Which I know, Dave, you guys are hyper focused, and that's, doing things the right way is important to you. But making sure that the exchange is handled the right way, and the investment, as the structures is done correctly, is really critical.
One thing we wanted to do is just give a little bit of perspective for different folks on different asset classes that you'll find within DSTs. I wouldn't say there's a lot going on in the farmland front. DST farmland, I think, is a little bit unique on in that particular category. But there's a few things to compare that's important for folks to understand as they look at what kind of DST they might want to get into. So we've just lined up in this comparative matrix farmland, multifamily, and then commercial with a few points, right? So non-recourse debt is available across the board. The same structure of being able to get in at that fairly low minimum investment. All three have the ability to access larger properties. Potential for single tenants, no vacancies. This is one that's fairly unique for farmland. It's certainly possible within the commercial arena, but good quality farmland in the US very literally has zero vacancy. And another advantage we see on the farmland front is that annual rent can often be paid in total, or at least a large chunk in advance of a particular growing season of the period of the lease. And then one thing that we like to inform folks about is the federal crop insurance program that creates a minimum annual revenue guarantee for the operators of farmland. This is really important for maintaining annual cash flows at an insured and guaranteed level. Non-irrigated farmland in particular isn't going to have structural repairs. That's certainly a risk that has to be budgeted within reserve pools on some other asset classes. Now, the leverage story is one that needs a little bit more detail. Farmland is not typically going to go much over 50% leverage. So folks that need more leverage may have to think about other asset classes on the DST front. Depreciation is certainly available in multifamily and commercial. It's possible on farmland, but you've got to pay close attention to how that asset is configured. Is it irrigated, or potentially is it an orchard or some sort of permanent crop holding that has depreciation on the trees or vines? Now, the marketplace is really well built out on the multifamily and commercial side. We're bringing offerings to the table on the farmland side, but it's not nearly as robust of a marketplace right now. And there is certainly the inflation hedge story has been at the forefront of folks' minds. Farmland has really clear characteristics as an inflation hedge. You also can see those characteristics potentially on the other asset classes. But this is important, right? Understanding what your particular goals are, what your needs are relative to some of the exchange requirements that Dave highlighted earlier, particularly on the debt and equity side, and then how different asset classes can fit together in order to meet your needs. We do currently have an offering available as DST Farmland. It's a Central Washington Farmland Trust. It's 2 assets up in Washington State. And if you're interested in learning more, you can find this deal through our broker dealer, AcreTrader. You should be able to get to it through acretrader.com fairly seamlessly and be able to learn a little bit more about this particular DST opportunity. So with that, Dave, do you have any closing thoughts for folks that have tuned in here?
The only thing I would say is it's a process. It's an education process, and it's a planning process. So the sooner you can think through some of the things that we've discussed, the sooner you can get in touch with your tax and legal advisors, the sooner you can connect with us, and to help with your exchange, and then obviously you know, looking for replacement property within that 45-day time period is, that those time factors are, you know, can be important. So, and Dave can be a resource for you, but, you know, folks are more than welcome to call or reach out anytime. That's how we built our business, is by serving as a resource. Our contact information is on the screen there. And once again, Dave, appreciate the opportunity to be with you.
Yes, thank you very much, Dave. Encourage anybody to reach out to learn more about DSTs and farmland, and then certainly 1031 exchanges. IPE will do a great job. So thank you all, and look forward to talking to folks.